Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Wednesday, March 26. U.S. Treasury Secretary Paulson gave a speech today that every investment banking firm knew was coming, but no one wanted to hear. Addressing the U.S. Chamber of Commerce, Paulson all but declared these firms should be subjected to increased regulation if they are going to be borrowing from the Fed. The viewpoint is understandable in light of the stress in the financial markets that has stemmed from their esoteric dealings in derivatives and credit products that have given everyone an acronym-induced migraine. The coup de grace that drove the call for more regulatory oversight, it seemed, was the Fed's historic decision to open its discount window to the investment firms. That decision came in the midst of the Fed orchestrating a Bear Stearns rescue that kept the firm from filing for bankruptcy and which prevented the likelihood of an epic sell-off in the stock market driven by a crisis of confidence in the financial system. In this act, the Federal Reserve carried out its all-important role of serving as lender of last resort. Doing so reflected the seriousness of the situation. With taxpayer money on the line, though, and the Fed in the position of needing to shore up the world's most important financial market, it appears the borrowers are not going to be given a free pass after all. Granted, the borrowers still have to pay interest on these loans from the Fed, but the more burdensome cost to the investment firms would be increased regulation. For individuals on the outside looking in, it sounds like a very practical and necessary condition. For investors in the affected companies, it is discordant music to their ears. For the time being, the idea of increasing the Fed's oversight of the Wall Street investment firms is just that. Yet it is reasonable to think it will come to fruition given these firms' lack of understanding of the risks they ran with their own financial dealings and the strain that is placed on the financial system. While the investment banks already face a more challenging earnings environment, the specter of increased regulation is yet another negative that is working against the group. Inevitably, when regulation picks up, earnings prospects go down. That's not to say the investment firms still could not turn a tidy profit, but the profit won't be all it can be amid more regulation. That understanding goes a long way toward explaining the weakness seen in the investment bank stocks on Wednesday. I'm Pat O'Hare for Briefing.com. Thanks for listening.